Hello, this is Bradford Townsend. I'd like to give my fourth quarter 2015 financial and economic forecast, um, focusing on the United States. This won't be too long. These valuations for the stock market are above the historical means and medians. Um, this You must take into account that we have zero interest rates and there was quantitative easing. These are unprecedented. So, as an economic historian who looks back at prior cycles of expansion and contraction in the U.S. economy, which are natural and healthy, um, it's a little harder. Each economic cycle um, is somewhat the same and has similar characteristics, and also each one is unique in its own time as technology changes. Right now, we have high-speed traders that are computerized, where massive amount of transactions are done without any consideration to fundamentals, and they may get in and out in seconds or less with relatively large transactions. Um, these competing computer models have been very good at generating profits for those who do them. The Federal Reserve is considering raising interest rates. Again, here things are mixed. Inflation is low. Petroleum prices are at relative lows, with strong supplies of oil relative to demand. So going forward, I don't see a whole lot of upside in the market. Um, when you purchase something, its price is critical. A stock could be a great investment at $20 a share and a bad investment at $35 a share. The same with bonds. Because inflation is low and the labor participation rate is low, and many of the jobs that have been created in the recovery since the mortgage crisis, which I saw coming, as well as the dot-com bubble crisis coming months, even years in advance, as the valuations of tech stocks were irrational, and you had a Dutch tulip bulb craze type phenomenon going on, with people hearing about all the millionaires and billionaires created in the high-tech sector. And then I personally saw with the institution I was with that bad loans were being packaged into securities and then distributed without any real considerations if these are viable loans or not. And loans began to default, and eventually that happened. This low interest rate, unprecedented zero interest rate environment with quantitative easing, putting a lot of money out there, mostly for the mega rich individuals and the institutions that are connected to the financial industry, means that money most probably has gone into bubbles and into places it probably shouldn't have gone if it was being made by rational investors. So I don't know if the Fed will raise interest rates. If I had to make a guess, I would posit that they probably will not, because job creation has been anemic. It has not created many desirable, good-paying jobs, and inflation is low, and the BRIC countries, Brazil, Russia, India, China, all are showing problems. Greece and Spain have over 20% unemployment. Um, so with a lot of problems around the world and an economy struggling and trying to readjust, I don't see, even if they do raise interest rates, for it to be significant, and would venture to say that they probably will not raise interest rates, that stocks will be in a trading range. They will be volatile, which means they'll jump up and down. And I'd like to make a comment about one of my heroes, Benoit Mandelbrot, the mathematician who's famous for fractals. Um, he also studied the markets and charting and found out that charts are not predictive. They are actually not as good as astrology when it comes to investing. At least astrology uses the arch Jungian personality types, where you can learn a little bit about human nature and the different psychologies of people, even if they don't causally correlate. Where charts, when they were given out and not told what the charts were for, charting experts and people who use charts were not able to do much with them. And all that you can tell by charts and volatility is that if the markets are up, then they might be down the next day. If there is big swings will probably continue until that trend ends. And if we are in a placid, calm seas of markets, then that is probably most likely to continue. So I don't think your typical investor who does a mixture of stocks, bonds, and real estate investment trusts going out 5 years or a decade will probably see below the 6-7% pre-tax return, pre-transaction cost return, and I will be doing further videos on those. So one of the best things you could do is reduce your expenses, because that's for sure savings. If you have $100,000 or millions of dollars, if you can have that money managed for you and you pay less for it, then that's going to for sure make you wealthier. And real estate investment trusts are a good way to go because they provide current income. And I'm also a big proponent of dividend investing. Looking at the dividend aristocrats, those are ones that have continued to pay dividends year in, year out, and increase them over long periods of time. I think if you're a true investor and not a speculator, that buying REITs and dividend-paying stocks and diversified portfolio of bonds that includes foreign bonds and corporate bonds is your best way to go. But if you're looking for the 10% returns plus of the 1990s, I just think that valuations are too low from here, and there is danger in long-term stocks if inflation does find its way and they are forced to raise interest rates. Raising interest rates is bad for bonds, as it makes the new bonds more attractive and will make stocks or equities and REITs less attractive. So I would lower the exposure to bonds, put more into high quality dividend paying stocks, and a much larger portion than the average American puts into real estate investment trusts, and venture out there and learn about preferred stocks and convertible bond funds as they pay good yields. And historically, a lot of your returns have come from the dividends from equities. Too much has been made, in my opinion, of capital appreciation. So to sum it up, for the rest of the year, I expect continued volatility with periods of tranquility and bonds, probably not to move too much. But we still need to invest, so thank you. Be kind and have a great day.